you heard what Narina had to say, that a trend still working against banks like Standard Bank. Would you go along with that, that there are still a lot of headwinds facing our banks, despite them coming through relatively unscathed?
Yeah, there's a couple of headwinds facing the South African banks. Firstly, where's the credit growth going to come from in the next year or so? That should be quite muted. We also see that the low interest rates are affecting the endowment income on all the banks. And obviously there's issues in the structural liquidity problems that the banks are trying to face at the moment. So there are a number of headwinds facing the banks, but generally they're on a solid platform. It really depends on the economic growth. Banks are generally a reflection of the economy they operate in. If the South African economy continues to improve, then we would see that there's probably room for improvements across the banking sector.
Would you expect banks to have recovered quicker given the growth we saw last year in the economy? Wouldn't you expect them to bounce back? It looks like they are being held back by persistent bad debts, not being able to grow their asset books at this stage. Why do you think that is?
I think that the stickiness of non-performing loans has been somewhat of a surprise across the markets, and especially to us. I think mainly it's the slow recovery of the real estate market and this debt counselling process that a lot of the real estate loans have to go through now. That's definitely affected them. The lower interest rates, obviously, as I said, has kept down the earnings. But so generally, yeah, it's been
low interest rates, though, are a double-edged sword because they do have the endowment effect on banks. But when we start to see those rates rise, if consumers aren't ready, we could see a rise in bad debts as well, couldn't we?
Absolutely, we could. And I think key differentiating factor across the banks will definitely be the control of operating costs and the control of cost of risk. The banks with the best risk management would have factored in that increase of basis point into what their increase in NPL will be, what the increase of cost of risk will be. So generally we'll see an improvement in interest rates will improve earnings, I think, but it will definitely increase the cost of risk at the same time.
You do mention that they fall short of Basel III funding and liquidity requirements, and this is something that's been brought up before because although they are well capitalised, they do have that asset mismatch, don't they?
All banks have an asset mismatch. Banks generally take short-term money and move it into long-term money. That's what banks functional do. South Africa isn't unique in this, but South African regulators and the banks have been quite proactive in the way that they're looking to change the financial system, change their funding base to deal with this problem. But it's still definitely a problem. It's definitely something that is going to rattle on for a while. The regulators have recently said that they're not going to allow covered bonds. That was quite an interesting move, especially as there's the need for long-term funding. I think the banks would probably quite like covered bonds, but the regulators have been quite conservative in the past. I think there's probably going to be some need to improve the term of their retail deposits, and that will probably be a trend in the next year or so. Will
changing that funding base make them less profitable going forward?
It would definitely increase the net interest expense, I imagine. If they solely concentrate on increasing the term of retail deposits, if they can diversify, then perhaps it might not have such a muted effect, but that's to be seen.
Well, if you think back a couple of years, we had these banks trading on ROEs north of around 25, so in the mid-20s. That's come down quite sharply since then. Is there a new normal, do you think, for South African banks in this more regulated landscape and this changed landscape since the financial crisis?
Yeah, absolutely. I doubt we'll see those ROEs for quite some time to come, to be honest. As a rating agency, we don't particularly worry about ROE, but because the lower equity have the higher ROE, and that's never a good thing from creditworthiness point of view. But generally, we won't see that, and unless the economy really improves and people start, corporates start increasing their gearing, households become more confident, the real estate market improves, then earnings is going to be somewhat down. So the banks are really going to have to control that cost base, operating and cost of risk.
How about competition in the banking sector? Because we see a couple of smaller entrants starting to make big headways, banks such as Capitec Bank. Is that a concern to you for the big four banks? Do you think that they're strong enough in the market that they can take on Capitec in that low-end market?
It's not a concern for the competitive dynamics. Capitec and African Bank have proved that their operating model bears well through a cycle, which is obviously a good thing for both of those banks. I imagine for those two banks there'll be more entrants into that market. I think FNB have been kind of the most public in saying that they're willing to move into that space, and from a credit growth point of view, actually that's probably where a lot of the credit growth will come from, although it remains such a small part of the major banks' portfolios that it's not really going to affect their creditworthiness
So that wouldn't affect any risk for those banks as they do enter the unbanked markets?
If they really enter it in a really big way, really increase their loan volumes, and so it really starts to affect their volume of loans and their share of loans in the portfolio, then it could do. But they've got a long way to go before that happens.
How are you seeing the recovery for banks so far? Because you heard those Standard Bank numbers where they are still under pressure. They have seen a bit of a turnaround from the end of last year going into the beginning of this year. Do you think it's intact? Do you think we are going to see that momentum build as the economy starts to gain some traction?
It's all down to the economy, to be honest. If the economy continues to improve, then yes, the banks will continue to improve. If they can pick the good loans, if they can control the costs, then the recovery will continue. If it doesn't, however, then there could be if the hypothetical double dip happens, then maybe the banks will go through another set of problems, especially in kind of the housing market. But generally, the recovery's been okay. As I say, going forward, there's going to be more differentiation. However, I think some of the banks that have more conservative risk management, some of those guys who have already got their bad assets out, they'll increase and improve their profitability a lot quicker.